Now, we're obviously coming off that jobs report. Investors really haven't had a chance to respond to it. Futures, pretty muted right now. What do you see the reaction today after that jobs report that was in line for last month, but February, we actually saw that upward revision?
Yeah, so we're still working through what's going to be a slowdown in the economy, and the jobs report started to hint towards that, maybe not as slow as some might have hoped. But you're seeing private sector employment slow, wages are becoming more muted. So it's a positive sign. It almost felt like a soft landing type of report, and that things were slowing and inflation wasn't it's remaining a big challenge. Now, we're probably not going to get through this with a soft landing, but nonetheless, a report that clearly wasn't of particular concern to investors. And what people should remember is that's lag data anyway.
Well, you got to explain that one, Brian. You said it was a soft landing-ish report, but you don't think we're headed towards a soft landing. So kind of reconcile that for me.
Yeah, well, I mean, it was a report where job growth continued to remain reasonable and inflationary pressures seemed to moderate, right? Wages were not robust. So that's that sort of, that's an environment where growth remains okay and inflation stops being a problem. So it was I would call it a soft landish type report, but I think it's hyperbole or an exaggeration to think that this is an economy that the first time ever can get through 500 basis points of interest rate hikes in an incredibly short period of time without having a recession. It's very likely that we will. The guideposts on the path to a recession are here, whether it's inverted yield curve, banks tightening lending standards significantly. Now, the good news is for investors is the markets did a pretty good job. The equity market did a pretty good job of pricing a recession last summer, and the market leads the economy, not vice versa. So it doesn't have to be anything that investors significantly fear. But nonetheless, it's an economy that's slowing meaningfully.
Okay, economy slowing. So we have three pretty big reports coming up. We mentioned CPI on Wednesday, PPI on Thursday, then big banks reporting their earnings on Friday. How should someone position today, knowing that these three potentially market-moving reports are coming up later this week?
I mean, we're still in an environment where investors want to be more defensive. Now, that's not going to last forever. That's very much more of a tactical call as the economy slows here. But what I remind investors is that once inflation has peaked and is coming down, and once the Fed backs off its tightening cycle, you usually see markets do well over the next couple of years. So I would say tactically defensive, but keep your eyes on what's going to ultimately be a market that's looking forward to the new business cycle. And so you have a little bit of challenge until we get there. Now, the consumer price index is front and center. That's what we've all been focusing on. It's going to continue to show that inflation's moderating, and inflation will come down. It will get back much closer to the Fed's comfort zone. And as that happens, that's when the Fed pause or policy shift happens, and again, the new market cycle emerges. Now, a little bit of challenge before we get there, but ultimately the recovery phase plays out.
All right, so a little bit of challenge before we get there. Very quickly, give us a sense, what percentage equities, what percentage bonds, what percent cash potentially right now, knowing that everything could change as of Friday?
Well, when you think of a 60-40 portfolio, you don't need huge swings in that portfolio. You want to make sure that the 40 is protecting you. And so, you would or increase some exposure to bonds than you would typically have, whether that's 45% up to 50%, but make sure it's high quality bonds, investment grade corporates or high quality treasuries.
Okay.
On the equity side, you want to be more defensive. So, that means larger cap, that means growthier, that means lower stocks that have historically had lower volatility or more defensive sectors. But, for investors, this is about what's the next, 5-10% move going to look like, which could be a retracement of some of the gains we've seen this year. I do think the bottom's in for this cycle, right, so you may have Brian, some retracement here.
Don't want to cut you off, but you are straddling the fence a little bit on some of this, so I want to put you on the spot just a bit. If you had one word to describe the investing week ahead, what would it be?
Volatile.